Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 2nd of July. I'm Daniel Lam, your host for the podcast. Since the ceasefire between Israel and Iran, the One Big Beautiful Bill Act had taken up the headlines in the investment community. Now this passed the Senate overnight by the narrowest of margins, required by VP J.D. Vance to cast the tie-breaking vote. Now this will go to the House of Representatives later today. Now the new bill would make permanent large tax cuts that were temporarily put in place when Trump was first in office. And it would increase spending for border security, defense, and energy production. All in all, estimates show that the bill would add $3.3 trillion to the US deficit over a decade, providing a significant fiscal boost to the economy. Now, the market reaction overnight in the US was muted. Now, earlier this week, the S&P 500 went above slightly the key level at 6,200, which we highlighted as a major resistance in our previous publications. Equities and US 10-year government bond yields were essentially flat after the passing of the bill in the Senate. This shows that the tax bill has more or less been priced in, with the markets focusing now upon the upcoming data. As we talked about in yesterday's podcast, we need to see the US economic data surprising on the upside in order to propel US equities higher. Now, we continue to be leaning towards, quote-unquote, the milder camp in the performance of US economic data. Softer labor market data remains a concern. Initial claims have been trending higher. Payrolls seems to be trending towards a print below the plus 100,000 mark versus the plus 110,000 street consensus. And of course, there's still upside risk to inflation. Positioning is an important factor supporting US equities, counteracting risk from macro data. Currently, investors are still under-owning US equities by historical standard at minus 0.6 standard deviation from neutral positioning. So what should investors be doing with US equities? Well, there's no evidence beyond a mild correction in US equities. So investors should be looking to only trim their excessive long positions there and rotating into other global equity markets which are trading cheaper, such as Asia ex-Japan, Euro area, and Japan. The removal of the feared Section 899 in the tax bill is a positive for the rest of the world equities. Finally, within US equities, they can be looking to rotate into the major US banks. Now, the Fed has proposed to ease the enhanced supplementary leverage ratio, which would ease capital requirements for the large banks. And this, to us, bodes well for further banking deregulation ahead. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.